Discover various financing options specially tailored for small business owners to help grow and sustain their ventures. Welcome to Lesson 1 of Module 7 in the Brick and Mortar Mastery course, Overview of Financing Options. Starting and growing a small business takes more than just passion. It takes capital. Whether you're looking to manage cash flow, expand, or cover an unexpected expense, understanding financing options is key to making smart financial decisions. Today, we're breaking down 3 major financing options for small business owners: merchant cash advances, business lines of credit, SBA and traditional bank loans. Each option has its benefits and risks, so let's explore which one might be right for you. Merchant cash advances. Merchant cash advances provide fast access to cash in exchange for a percentage of your future sales. Here's how they work. You receive a lump sum up front. The lender takes a fixed percentage of your daily or weekly sales until the total amount is repaid. Instead of interest, you pay a factor rate, usually between 1.2 to 1.5, meaning if you borrow $10,000, you could owe $12,000 to $15,000 back. Pros? Fast funding. Approval can happen in 24 to 48 hours. High approval rates. Around 84% of MCA applications are approved, compared to 57% for bank loans. No collateral required. You don't need assets to qualify. Cons. Very expensive. The effective APR can be 100% to 200%, much higher than traditional loans. Daily or weekly repayments. This can put a strain on your cash flow. Lack of regulation. These aren't classified as loans, so consumer protection laws don't apply. Best for businesses with strong daily sales that need quick cash for short-term needs, like restocking inventory or covering emergency expenses. Business lines of credit. A business line of credit is a revolving credit account. Think of it like a credit card for your business. You're approved for a set amount, say $50,000. You withdraw what you need when you need it. You only pay interest on the amount used, not the full limit. Pros? Flexibility. You borrow only what's needed and can reuse the credit as you pay it back. Lower cost than MCAs, interest rates typically range from 6% to 10% APR, much lower than MCA rates. Good for ongoing expenses, helps cover seasonal dips, payroll gaps, or unexpected costs. Harder to qualify, requires a solid credit score and business financials. Variable interest rates, your costs can rise if rates increase. Potential fees. Some lenders charge maintenance fees even if you don't use the credit. Best for businesses with steady revenue that need flexible financing for recurring expenses. SBA and traditional bank loans. If you need a large sum for a major investment, like expanding to a second location, traditional loans and SBA 7A loans offer low-cost, long-term financing. A loans. Government-backed, reducing risk for lenders. Loan amounts up to $5 million. Repayment terms up to 25 years for real estate and 10 years for working capital. Interest rates range from 9 to 11% APR, much lower than MCAs. Traditional bank loans. Similar to SBA loans, but with stricter qualification criteria. Typically require collateral and strong credit. Faster than SBA loans, but can still take weeks to process. Pros? Low interest rates, the most affordable financing option. Longer repayment terms, lower monthly payments make cash flow easier to manage. Great for expansion, ideal for real estate purchases, equipment, or acquisitions. Slow approval process can take weeks or months to get funded. Strict qualification requires good credit, strong financials, and often collateral. Personal guarantees required. Most lenders will require you to personally back the loan. Best for businesses planning long-term growth that can afford to wait for funding. Choosing the right financing depends on your business needs, cash flow, and risk tolerance. Need fast cash but can handle daily payments? Consider an MCA. Want flexibility with borrowing? A line of credit might be best. Looking for low-cost, long-term funding? SBA or bank loans are your go-to. Before applying, always compare costs, understand repayment terms, and ensure the financing aligns with your goals. Thank you for watching.